they exited. And ultimately, I found that it's fascinating. So I'm hoping to have a conversation like that with Jasper for you all to see and learn from his experiences. So, I mean, before I launch in, Jasper, is there anything that you'd like to say to introduce yourself?
No, I think the introduction has been made. Thank you very much for that. And let's dive right in.
Okay, well then, I couldn't agree more. Let's get to it. I think the first question that I wanted to ask you is ultimately the starting point. So, I mean, how did you think about the funding of your business?
The funding of the business, right? So, I mean, let's start. I mean, I think with how it was all set up, right? So, I was working in Nigeria back in 2017, and one thing that is very visible in Nigeria, and everybody who's in this call can relate to that, is the constant humming of the generators. And so while I was working in an industrial company there, I already back in 2017, 2016 got approached regularly by solar companies, typically from Europe or the US, who wanted to install solar systems in Nigeria. And these offers just had one problem. They were incredibly complicated, difficult to understand, require a lot of upfront capital to invest. So it really didn't make a lot of sense for the Nigerian business they were pitching to. And so there was also very little success of these companies in selling anything. So that was then the business idea, really, to say, okay, this is something we think we can do better. This is something where we believe with a good structured product, we can actually do something for Nigerian companies that makes sense and provides them with clean, affordable power. And then part of that is actually funding these solar power systems for our clients and making them pay over time, right? So we build a solar power plant for $1 million, and then our client pays over the next 10 years for that system in monthly installments in one way or the other. So this means a very capital intensive business. It needs a lot of funding to actually be successful, because you only grow with additional money. It's not something that where you have a digital product and it can pretty much scale without a lot of additional investment. This really need every growth needs capital. So the beginning was really, really tough, So we had the idea. We installed our first system in near Abuja, and then we went and started talking to different founders, funds, and DFIs, etc. And that was a very humbling experience in the beginning, because initially nobody really wanted to give any money, and then B, the typical question we got is, "Oh, you're doing solar power, so you're doing what these other guys there are doing." And we're like, well, we believe we're doing a lot of things better than other guys, but yes, in principle, we were doing something that other people are doing as well. So it was very tough and very difficult initially, and I think we definitely caught a break when the German Development Bank actually has a very nice program for startups where they can get what they call a repayable grant. So you get a grant of €500,000, and you only have to repay it if you're successful. So we managed to get that, and that's how we kind of kicked off. And that the reputation of the German Development Bank then helped us to get our foot in the door with other funders as well. But it was very, very difficult initially.
And then, I mean, after that, how did you build on that? You kicked open the doors and you've had that first break and you've taken advantage of it. What did you do after that?
Yeah, after that, it was, and it always was, I think, in between funding rounds. I mean, everything you're always trying to do is trying to build track record, right? Trying to do something to show the next investor that you use the money of the first investors well, and you've grown the business, and which means there's a lot of opportunity for further growth, and the risk of failure has decreased, right? So that's what you kind of always want to demonstrate. So yeah, so what we did is, we started using the money, we invested it in solar power systems, trying to get first clients, which again was very difficult. Letting people or companies, let us on their roofs and install solar panels. There was a lot of skepticism in Nigeria back then, and a lot of questions like, can solar power power an air conditioning system? We don't believe it can. So a lot of skepticism, and again, same thing. You start with one client and then try to use their reputation and that track record to get the next one, and you start building from there. So our first client, our proper first client, was Unity Bank. So not one of the top Nigerian banks, but a bank that trusted us. So we installed first systems there on the roof, solar power systems, and then used that reputation and that proof that we can actually do it to get in the next customer, which then was Access Bank, which already is a bigger, more reputable bank than Unity Bank was. And so really moving step by step and going into bigger systems, bigger clients, and then on the way, of course, always having to raise more money because as we grew, we also had to raise more. And so it was a continuous struggle of getting more clients to build systems on top of the roofs, and on the other hand, finding the money to pay for it. So one of the two was always a bottleneck. Either you had money, but we were hustling to get clients, or you had the clients and you were hustling to get money. But it was really about managing these two bottlenecks.
And I mean, I really love that story, that explanation, which is very logical about how you build a track record. And so you can just show investors that it's a wise investment because people invested before, and then bit by bit you grow. I mean, I think one thing is lots of people who've tuned into this webinar
My connection has cut off. Sorry. Okay.
Hello, I'm sorry, can you hear me?
Yes, I hear you again.
Yes, sorry, I think I lost you for a moment there. Oh, you lost me rather. So what I was asking was, are there any practical tips in terms of negotiation? How can you pitch and negotiate effectively?
Yeah, I mean, it's a great question, I think. And I mean, I think it starts off with understanding what does the investor want, right? And that sounds simple initially because you think, well, investor wants a good return, yes. But how high is that return actually? And and what ratio of failures does he actually assume, right? So if you have a typical VC fund, for instance, a venture capital fund would be fine with a large portion of his venture that he funds fail, right? I mean, that's part of their business model. A lot of their investments fail, but the ones that succeed, they want a very high return on them. So they're more acceptable of risk. But they want to see really this very strong trajectory, very high growth, very amazing potential returns in the future. And then you have other investors, more for instance on development finance side, who are very risk averse, right? They also want a return, of course, but they're fine with much lower returns. But in exchange, they also want a lower risk, and they're not as happy. Well, they want a higher degree of assurance that the company will actually not fail. So I think understanding, with whom are you actually talking to is quite important. And then again, is it an equity investor or is it a debt investor? Same thing. A debt investor really wants his money back. An equity investor is more happy to gamble a bit. So also that's an important in kind of in the equation. But at the end of the day, I think in the negotiations that we had with all these various investors, the key for us was always to, I mean, as an entrepreneur, you're always selling yourself in these investment discussions. So I think the key point, first thing is you make a good impression of you as an entrepreneur and what you can do and how you can move this company forward. That is really number one. Then the second one is really the fundamentals of the company, right? Really making sure that you explain correctly why it's an amazing company, why it will have good returns, why it will be profitable in the future if it isn't yet, and why it's a good investment. And the key there really is, I think, to put yourself in the other person's shoes who may look at things very differently than you are, right? I mean, you as an entrepreneur are very excited, you love your company, it's the best thing ever, and an investor looks a lot more dispassionately honest, looks a lot more different on risks. And if it's a foreign investor, not a Nigerian investor, he will look, he will have a lot of concerns about Nigeria risk, right? Because he doesn't understand it, probably hasn't worked a lot in Nigeria. So really explaining properly FX risk in Nigeria, you know, all the different details particular to doing business in Nigeria then becomes very, very important, and providing the assurances that you know actually what you're doing.
Okay, thank you very much. Well, I think you've covered comprehensively the initial stages of fundraising. So then the next stage is growth, expansion. So with that in mind, how important was it for you to have a growth strategy?
Yeah, having a growth strategy, I think it's an important part for different reasons. I mean, one, investors will want to see it. They will want to understand the strategy for growth of the company. But beyond just what investors want to see, it's useful to have that for yourself, because as an entrepreneur and CEO, you're always so in the middle of it, so in the thick of it, and in the middle of the action, in the battle, so to say, and it's then very, very hard to be structured about things. So if you have a plan, a made-up plan, it's much easier to actually say, okay, let's follow that in a structured manner and really execute the plan and measure ourselves against it. And it's much easier to do than if you don't have a plan, then you just reacting instead of actually acting and executing on something that you believe in. So that's why I think it's important. And it's also helpful to think a bit about how you want to grow and where you want to grow and what the cost of that growth is, especially right now. So, you know, investors were always very keen on growing companies, right? So they want to see a strong trajectory of growth, 40, 50, 60, 100% per year. But right now, their priorities have shifted a bit, and they also want you to be profitable as a startup as quickly as possible. So we now have to balance growth with profitability, which means the growth we're actually looking for at the moment is profitable growth. And when you're looking for profitable growth instead of just growth, it becomes even more important to have a proper plan, because you really need to look at and say, okay, what growth is actually adding to our bottom line? What growth will not cost us money, but actually give us additional profits? And that might sound simple, but in the past, the last few years, it didn't matter if you grew and it cost you money. I mean, as long as you increased revenue, everybody was happy. That time has gone. So now we really have to look at growth in a way that the unit economics at least are positive, and ideal the economics overall are positive. So that's why it's very important to have a plan for that. And just thinking about Daystar Power here, when we thought of growth, we think about it in terms of products. So yes, we do solar, and then we can add battery storage to it, and we can also, install more efficient air conditioning sets. Then we can help you get a gas generator as well, which is also cleaner than diesel, etc. So this product growth, that's very interesting. And then there's, of course, the geographic growth, which is very exciting, I think. Where again, we always looked at, okay, let's focus on the countries we want to go in along two criteria. One, how big and attractive is the market? And number two, how difficult is the market? And difficult has many aspects, right? So Angola is more difficult for us simply because it's Portuguese speaking. The Francophone West Africa is pretty easy once you're in, because they're also similar in terms of regulation. So yeah, it's important to have a growth strategy and really think in a lot of detail on these things.
And I just want to dive a little deeper into an issue you just touched on there. That's that geographic expansion. I mean, your business has expanded, as you said, from Nigeria to other parts of the continent. So with that in mind, just broadly, what was tough and what was easy? I mean, I know you've given the examples of Angola, for example, and the linguistic difficulties therein, but it would be good to know, just get a sense of more broadly, what was tough and what was easy?
I think the toughest is always to understand the economics of a new market before you enter. So in our case, because we deal in physical goods, so a solar panel has to be imported, understanding, I mean, how much will it actually cost to import this equipment and then put it on somebody's roof? That's really hard, because not every country has everything that public, this information. If it is, common practice is sometimes different than what you read in official documents. And that's including Nigeria, by the way. So understanding really what are your costs and what prices can you charge. I think that was always the most difficult step for us when entering a new market. After that's done, all the rest, the legal work, setting up a company, all that's relatively easy. It may cost money, you need lawyers and so on, but it may take time, but it's not particularly hard. The hardest really is to understand the economics of entering a new market.
Okay, thank you very much. And as I say, we're working logically through this. So we've raised the funds, we've talked about expansion and the geographic model and how you've expanded from Nigeria to other countries. Then the next thing is exit. So with that in mind, I mean, I wondered, what can you do to make your company exit ready? I mean, how can you prepare for that?
Yeah, I think getting exit ready is something that you need to think. You need to think from the end, right at the beginning. So, who would buy my company eventually, and what would this other company, fund, whoever it is, be looking for, right? If buying my company. And there are some easier parts to it, I think. So what they're typically looking for is compliance. You shouldn't have, you should have paid your taxes when due. You should have followed all the laws. That's pretty much the basic. Then if it's a strategic buyer, which it was in our case, there will be a lot of interest in how actually is the company working? Do you have policies defined for things? Are there proper processes defined? Are there actually mechanics in place that a different company would have, a good company would have? Policies, processes, rules and regulations, abiding by laws, following, the advice of tax authorities and so on. So that's quite key. Then does it have a proper governance that has been set up, or can anyone in the company spend any money he wants? So all these things are quite important. And I know of companies in Africa who are profitable and attractive, but because they haven't reached these proper levels of compliance, are actually they can't be purchased by a foreign investor because they won't touch it, right? It's too dangerous for them. And it's again the same thing, right? If you have a foreign investor or foreign buyer, he wants to buy a company in Nigeria, a country he doesn't fully understand. If he now knows or finds out you've not paid your taxes properly, he'll be very cautious because he doesn't know what's going to happen. He might be a US investor. He knows what happens in the US. He knows how to deal with it there, but doesn't know how to deal with it in Nigeria. So the anxiety will be much greater. So I think that's really important, setting it up properly, following all laws, rules, and regulations. And that sounds easy. It's actually not that easy. Then the second one is, if somebody buys your company, typically they're going to buy it because they want to make it bigger and grow it, right? They want to take it from where it's now and they want to make more out of it. So you have to position your company in a way that this growth is possible, right? You're not holed in a market where there's no further growth there. It has to be a big market. It's something expanding, where the buyer comes and says, yes, I think I can take it from X to Y and it'll be much bigger 10 years from now or 5 years from now.
I mean, at what stage do you start thinking about all of this? I mean, I do wonder, because you've described it, and it's interesting the way in which you think about the inverse. You're thinking about who would want to acquire this and what would they want out of it, and essentially they would want to grow the business. But I'm wondering, how early in the evolution of a company do you start to think about this? Is it from day one? Is it after a year or two? Can you talk me through that process, please, that thought process?
Yeah, I mean, we didn't think about it on day one, but we started thinking about it 2 years in, and that was triggered by our first bigger investor coming in, and which was or is a Nigerian private equity fund. And if institutional investor like that invests in your business, they will think about who would buy this, right? Because otherwise, if they have no clear answer to who is going to buy this company in 7 years, they as a private equity fund wouldn't be interested to invest, because they want to sell the business at some point. So that's started triggering the thought process, right? Because then when this investment happened, we had discussions with them about that, saying, okay, who would buy this? Who would be interested? So I think at the time of the first proper investment round, the thought process around that will be triggered anyway, in all likelihood, by the potential investor. But I think it does make sense to think about this earlier, and think about it even when you're in the idea stage or about to set up. It does make sense to not only think about, okay, what product am I offering and who would pay for it, and is it profitable? It also makes sense, okay, is this then interesting at some point for an exit? Because if it isn't interesting for an exit, then you immediately close off a lot of potential investors, like all these institutional investors who invest in a company and then sell it 7 years later. They wouldn't be interested, right? So I think it's a very important thought process and should be done as early as possible. We didn't, because we're also first-time founders, so we did a lot of things wrong and could have done a lot of things better.
Okay. I mean, I'm very much coming at this from the perspective of being a journalist. As I mentioned before, I've very much been a business journalist, and these are things that I've written about. So I'm always on the other side, marveling at people like you who take these risks and make these decisions. Now, one thing that I always wondered about and still wonder about, and hopefully you can explain, is just the different options for an exit that are available to someone like yourself. I mean, there's the management buyout, there's acquisition, there's IPO. So please, can you just talk us through the different models? And just before you answer that question, I'll give you a second to think about it. Just a basic public service announcement. Please, to anyone watching this, if you have questions, we've allotted time in this. So please do send Jasper your questions. This is your opportunity. Anyway, Jasper, please, on that question that I posed to you, what are your thoughts?
Yeah, it's an interesting one, right? And so let's start with management buyout, right? So management buyout, I think works if the company has to be profitable. Otherwise, it doesn't really make sense. And so I guess it really depends very much on the type of business, actually. So, and the times and the current economic climate, right? So, in the past, or last 5 years, it was possible to IPO with a company that's not profitable. It was possible to sell companies relatively easily. Investments and funding flowed relatively easily. So there were a lot of options open. I think now everything is a bit more difficult. And so not every option is available anymore. But let's actually start with IPO. So IPO needs a certain size. And so it doesn't make sense to do it at a too early stage. The company needs to, have a certain size, as I said, and be typically on a strong path towards profitability. May not have to be profitable yet, but I think it has to be very clearly in the headlights. IPO comes along with a lot of bureaucracy, right? So you have to comply with the exchange where you're doing your IPO. There's going to be a lot of legal requirements, particularly on the CEO. You have to hand out quarterly results. So a lot of things get a lot more complicated and difficult, right? So I think IPO, and unless it's a full exit, it complicates the life of the CEO quite a bit. So it's something to think very hard about whether one wants it. Then there's the always a sale or exit to another fund, right? Another PE fund, a bigger PE fund. That's quite good. They typically then buy because they have to give another 7 years or so to achieve a next step change in growth. I think when we talk about VC and PE funds, they're obviously very hard-nosed investors, right? They're tough. They've done this 1,000 times. They know every trick in the book. They are going to look out for their own profits, and they're not going to treat you fairly, right? I mean, that's just realistic. And you're as an entrepreneur, you're at an immediate disadvantage compared to them because you're doing it for the first time or second time or third time, and they're doing it for the 100th or 1,000th time, right? So there's this vast difference in experience and knowledge and how to do things. And I think one of the things I always found very annoying when fundraising and discussing with investors is when they said, well, this is how it's done, or this is standard, because nothing really is standard. It's all negotiable. Then we have sale to a strategic. I think what's nice about a strategic is that while they do want a return and do want to make profits, the return they're seeking is typically not PE fund type of return, not that big. It's they typically wouldn't have done this so incredibly many times, even though they might have an M&A department. So the disadvantage in experience is not as great. And usually they're looking for something else, not just pure returns, right? So if a strategic investor buys you, they might be looking to enter a new market segment that's adjacent to them, or fill a gap in their product portfolio or get a new access to customers, something like that, right? So you're not being purchased or acquired just for the pure return, but there's something else. And I think that's typically quite interesting. And sometimes they can also provide synergies to the company they're buying, which is very interesting. And then lastly, management buyout. I mean, it's not something I've thought about too much, but can of course be interesting if the business develops into something that really then would allow it to pay very nice dividends over time. So could be interesting, but I haven't seen it that much, to be honest.
And I mean, in my imagination, and I think in reality, I mean, there is a certain subsection of entrepreneurs who are friends and they get on and they learn from each other. So I just wonder, with that in mind, I mean, have you seen any successful exits? You don't have to name the companies, but just exits that you've learned from where you've just thought, oh, I like the way they structured that deal, or I thought that was an elegant way of doing things. Just wanted to have any examples there.
I mean, usually I don't have any access to the exact deal structure, but I think if I'm looking at the deals others made, I know one entrepreneur who I admire greatly in Europe, who got a strategic investor in, and who took, I don't know, 40%, 49%, or almost half of the business. And what I thought quite nice about is they got funding from this investor, or a strategic investor, and an agreement that the remaining shares will be sold to this investor in a predefined time period at a certain valuation, depending on which has a range, then depending on how successful the company is doing. And then this strategic investor has left this company, to grow without interfering. And I think that's quite amazing, because because typically if you get an investor in, what's quite annoying is that they interfere. And of course it can be helpful sometimes. Usually it's not so helpful. Usually it's distracting and irritating, and you rather want to minimize interference. At the same time, you want money. And what this entrepreneur did is he actually got the money, no interference, and the security that he's able to sell this business at a valuation that he can calculate himself, basically on a sheet of paper, in I think it's 4 or 5 years' time. So I thought that was quite a neat deal, a difficult deal to pull off, I think, because typically, as I said, if you get one of these investors in, they do tend to interfere quite a bit, especially if they know they're going to own the business in a couple of years. There's a strong tendency that they might want to make decisions which then interfere with your ability to make profits or grow as quickly as possible, and so on. So, but that was a very nice deal.
That's a great deal. And that's exactly the type of anecdote that I was looking for, because most people don't have people in their circle of influence or people that they know who would have pulled off something like that. I mean, out of curiosity, I was really interested and struck by the point that you make, which is probably obvious to you, but not necessarily obvious to everyone, which is that there's an imbalance between investors and the people who have built a business, because the investors, it's not their first rodeo. They've done this a number of times, and with that comes practice and experience. Out of curiosity, in that anecdote, was that the business person, was that their first business, or had they done it before?
No, I think this one anecdote I just gave, it is his first business, and the person had a very bad experience with a previous investor, and then was quite lucky to get the strategic investor in. But I think in this case, I mean, there was a lot of, I mean, unfortunate to say, there's a lot of luck in it as well, right? And I do think strategic investors are easier to talk to and easier on average to reason with and get to a joint agreement that just makes sense. Whereas your typically VC and PE fund might be a bit more difficult and a bit more tough.
Okay, well, thank you for that. I now have an audience question that I want to throw your way. So thank you very much. It's from Raj Kulasingam, and the question is this: what are your thoughts on carbon credits and the ability to trade them? And then there's a second part: is this part of your business plan and roadmap?
Yeah, thank you. I mean, I think carbon credits are super interesting. It's something I have looked into in a lot of detail. I even thought about setting up a business on carbon credits, but I didn't eventually. So why not? So I think carbon credits. So you think of the carbon credits market, there's two types, right? There's voluntary carbon credits, which are issued by independent agencies or nonprofits. And then there's legal carbon credits. For instance, the European Union would have a carbon credit scheme for airlines, for instance. So on the voluntary carbon credit market, the problem we have there is that you have different issuers, typically nonprofits, who can change their regulation, what counts as a carbon credit and what not, on a whim, right? So they can just, like that, change their decision. And they did actually, not so long ago, they made a decision that solar power carbon credits from Nigeria are not valid anymore, or you get new ones. Why? Because solar power is too profitable in Nigeria. It's too attractive. So if you build a solar power plant, you can't get carbon credits for it in Nigeria, but you can get carbon credits if you build it in Chad or not Niger, because these are much poorer countries. So this ability of these arbitrary nonprofits to change regulation, that's a tough one. The second issue with carbon credits is they really require a lot of trust by the person who buys them, right? So you have to trust the issuer that these are actually valid and there's something real behind a real CO2 saving. And yeah, so there's a lot of inefficiencies there, which, yes, are ripe for somebody to come in and do something about it. I look forward to when that happens, but it's a complicated area. It's a complicated business to solve that, but I think it's an exciting opportunity.
And as I've mentioned before, the joy of being a journalist ultimately is I get to just ask lots and lots of different questions, and I'm just fundamentally curious. And one thing that I always wonder and often ask entrepreneurs when I speak to them is, why do you do this? Like, why? I mean, presumably it's not just the money. So can you just talk me through your mindset? And I mean, we did have an introduction to you, but I'd love to know more about how your journey in terms of mentally, psychologically, why you do this, what motivates you, what inspires you?
Yeah, it's a good one. I think it's really tough to be an entrepreneur, and probably not everybody is made for that, because you're facing a lot of pressures, obviously, and depending on how the business is going. But I think most entrepreneurs I've talked to, even the very, very successful ones, have periods when setting up their business, when growing their business, when everything seemed to fall apart. Like these moments when, oh my goodness, I mean, everything could be gone. Could be bankrupt tomorrow. So most entrepreneurs I know have had these experiences, and that's really tough, right? So it's very, very difficult, these moments. And of course, there are also big joys when you have successes and so on. I mean, I think for me, it was always just a lot of fun to set up a business, think it through, have the freedom to, to try something new, to make decisions. That I always found very enjoyable. The pressures that come with it sometimes, as I mentioned, those are not too enjoyable, but I have to say you get used to them. So the fear of, going bankrupt comes less over time. The longer you have spent with like a cloud like that hanging over your head, you get used to it. So I think the big advantage of being an entrepreneur is you get a lot tougher, and the things that are not so serious, you don't take them that serious anymore, and not as anxious anymore. So I think my anxiety of things in general has actually reduced over time being an entrepreneur. When I was still in consulting, I was a much more anxious person. More anxious what my boss say, if my slides are not pretty enough, or if I made a mistake in my Excel model, oh goodness, what will happen? So being an entrepreneur, that really puts into perspective, like these things all really don't matter that much. And so that's, I think, quite nice, getting these experiences. And one other thing I really love about being an entrepreneur, I have to say, is meeting other entrepreneurs. That's so much fun. And that's, by the way, also why I love Endeavor so much. So Endeavor is truly fantastic because it is this platform for entrepreneurs where entrepreneurs can meet and mingle and learn together and share these experiences, which truly everybody has, right? So if you're an entrepreneur listening and you have a terrible experience or things go terribly wrong, I mean, in Endeavor, there's probably dozens, if not hundreds of people who have had a very similar experience in the past and can share how they dealt with it. So that's what I really enjoy about it.
Thank you. And thank you so much for articulating that, because as a journalist, often I've been there writing about the anxiety or the deal that's gone wrong, or, and it's really interesting to hear the flip side, about the fun. Now, we have got a couple more questions from people who've dialed in. So one is, after Daystar's exit, what are your plans for the future? Are you still playing in the clean energy space?
Yeah, so we've exited, but I'm still the CEO of Daystar. So I'm going to stick around for a while and continue growing that business. Yes, I mean, looking beyond that, I think maybe not clean energy, but I think clean tech is something that I find really interesting.
What's the difference, sorry, for the uninitiated?
Yeah, so everything around moving to carbon neutrality, right? So if you think about it globally, what is happening, and you can think about climate change, what you want to think, globally what is happening is everything is moving electric, and energy is over time going to shift green. And I don't think that's really can be stopped anymore. I mean, huge amounts of money are being shifted into these things now. On a daily basis, and the investments are staggering. So if you compare, for instance, the investments made in the battery industry, lithium-ion battery industry, and the revenues that will come out of that, it dwarfs the revenues made from, for instance, online advertising in the US. So the market is much bigger than the market Facebook and Google are fighting over. So this whole green energy, green technology space is going to be huge. It's very technical, though, very interesting, but a lot of room for entrepreneurs to do interesting things and help companies and households to reduce power costs, to increase efficiency in all these areas. But it goes beyond that, goes into green agriculture, etc. So there's a lot of room. And a lot of investment in that area, so much easier to get funding.
Which is interesting, actually, because we have another question, which is to that point, and I know you did go into some detail about this, but just very broadly, they've asked, how do you find investors, or how do investors find you?
Yeah, I mean, we've been approached one or the other time by investors, but usually we approached investors. And typically that is by, a lot of it is Google search, finding the names, going to the website, looking who's the right person, trying to call them, send an email. So a lot is that, just that. Talking to people, right? So asking them who are investors that would be interested in the space I'm in. So it's other entrepreneurs, other investors as well. So if you talk to an investor who says, well, he's not interested because this is not what he does, well, do you know somebody who could be interested in this? Because the investment community, everybody knows each other more or less. And so I think, yeah, that's the way to do it. And then, of course, there are databases out there of venture deals, right? So investments. And some of them you have to pay for, but sometimes they're for free. But if you look at a database of, all the VC deals in Africa in 2022, for instance, all the names are there of the funds, right? And then you can look at who are there, who's actually investing in Africa, what type of businesses are they investing, and I think that's the way to do it. It's not easy, it's not fast, but it's it's probably the best way to do it.
How do you find those databases?
So typically, I see someone post them on LinkedIn, yeah, I mean, I don't know. It's I think over time you build up this network. But if anybody wants a database like that, I mean, I know where to get it from, so I can share that. I will look for it afterwards.
Great. Can people tweet you? And what's the best way to reach you if people have follow-up questions for those who are too shy to ask you or didn't get a chance?
Yeah, best is always on LinkedIn. So just connect with me, send me a message, and I'll respond.
Excellent. I encourage anybody who has burning questions to do so. I think we've got time for one more, so I'm going to find one here. What were some of the aspects that led from collaboration between Daystar and Shell to the ultimate acquisition?
So, I mean, it pretty quickly went to acquisition. We didn't collaborate a lot before then. We had been in touch a long time before then. We had been in touch with Shell previously on a minority investment. So there had been an ongoing dialogue for probably 2 years already. And then that in last year, when was it? In 2022, that then really quickly moved into a potential acquisition. And so we didn't collaborate much before that. But I think personally, if you have a strategic or a big company you can collaborate with before actually they become an investor and then buy the company, that's of course very helpful, right? Because you get to know them, see how they are, what the culture is. So that's very helpful. The only downside is if you get in bed with a strategic investor, you might be blocking other potential strategic investors, right? So taking this example, I mean, if you're in bed with Shell, Total is probably not an option, right? So if you're with Siemens, then GE is not an option. So I think that's the one downside.
Okay. Well, sadly, time is not on our side, Jasper. It's been great talking to you. To briefly summarize what we covered in that hour-long webinar, you said we should build a track record for investors, show that an investment in your business is a wise one, and then incrementally scale, build up bit by bit. As well as that, think early on in the process about who would want to acquire you. Just think from their perspective, and also consider the different exit options that are available. And above all, it will be stressful, it will be full of anxiety, but you're having fun, you're in control, you make the decisions, which I thought was an inspirational message and one that we should probably end with. As you said, if anybody has any further questions, they can follow you on LinkedIn and post those questions there. And I'm on Twitter as well if anyone has any questions, but I think all the questions will be for you, Jasper. It's been a pleasure talking to you. Thank you so much for your time.
Thanks a lot, Alexis. It's a pleasure as well. Thank you.
Bye-bye.